Good morning. My name is Lynn Gillette. I'm the president of the Silicon Valley chapter of AAII. I'd like to give you a welcome. Okay, our program title today is 2020 Investors Tax Update. I had a member send me an email recently, and the member stated that his favorite program for the year was the tax program. So it certainly is a program that generates the most questions, I think, of any subject. Our speaker is Russell Barnett. He's an enrolled agent. He's CEO of the Silicon Valley Tax Coach, which is the name of his firm. He lives in San Jose, has worked in the Valley for quite a while. He's proactive in working with his clients to reduce the tax burden and ensure compliance, and certainly to save his clients money. I'll read a little bit of the description to give you an idea of what will be covered. 2020 has been a year filled with tectonic changes for investors, for businesses that are impacted by the COVID virus pandemic, to potential difficulties collecting rent from tenants whose income has dropped and or become unsteady. There was a $3 trillion infusion of economic aid through the FFCRA Act and the CARES Act of 2020, which made a massive change, and massive changes occurred to the tax code. Some of these changes are retroactive and many are highly impactful to investors. Russell will go over changes to the tax code, explain the changes, why it is relevant to investors, and how it can save you money in 2020 and beyond by understanding these. So with that introduction, Russell, you can have the floor, and your program is already on everybody's screen. So welcome and good luck.
Thank you. And thank you everybody for inviting me to talk to you today. Like the description said, we've had a lot of things going on this year. We don't really need to tell you that, but I did anyways. The FFCRA in the description stands for the Family's First Coronavirus Response Act, which I will go over a little bit. I realized in the description I probably shouldn't have used the acronym. The CARES Act is a little bit more easy to remember since Washington loves their acronyms. So, the first slide is just a little bit of information about me, like Lynn had kind of described a little bit. I'm an enrolled agent in San Jose, also a certified tax strategist, meaning that we specialize in proactive tax planning for our clients. We work to look ahead. Maybe an analogy you would identify with is, coming to your tax person in March or April and asking them how to save taxes is kind of like worrying about the cash flow for your rental property after it's already bought. You can't do much after the fact to change most things in the taxes, but you can change quite a lot by looking ahead. And so what we do is we take a proactive approach to our tax planning. We have saved our clients over $4.8 million in taxes over the last 3 years alone. So it can be highly impactful, and my clients love saving taxes, I'll tell you that. So, but we also, of course, work with our clients to take care of their tax compliance needs. And we also offer outsourced accounting services for small businesses. So, so that's just a little bit about me. You have the slide, and they put the slides up on the site ahead of time, so hopefully you can download them. You can access this anytime. And then the last slide will have my contact information on it if you need to reach out to me for anything. So, so I'm going to go ahead and dive in. As Lynn mentioned, if you have questions, please put them in the chat, and I'll try to answer them as we go. I did tell them that if we get bogged down too much on a certain topic, I may invoke executive privilege and just move on. But I will try to address as many questions as I can while we're talking, so that we can keep the answers and the questions kind of in the same area as what we're talking about. So, so there's two main bills that Congress passed, one in March and one in April, I believe. That would be the Family's First Coronavirus Response Act and the CARES Act, which I can't remember what it stands for, but it's on one of the slides. So everyone just calls it the CARES Act. The CARES Act had a lot more to do with the tax codes for individuals. the FFCRA had a lot of information about it and requirements for employers to offer paid time off for their staff that are either had contracted the coronavirus or was caring for others who had, or who were under quarantine or who were under government shutdown. So that was kind of the government's first response, is that, and the government paid for most of that. So they said, hey, everyone stay home for 2 weeks if you get sick, and we'll pay your employer to pay you while you're off for up to 2 weeks. Then it rapidly became apparent that was not going to be sufficient to address everyone's needs. So they took another swing at the CARES Act a little bit later with a lot of other changes as well. So I've tried to kind of keep the focus on the stuff that would be relevant to my audience, right? So there's some aspects of both of those acts that I'm not going to cover so much. If you have a question about something that that you think I didn't talk about, please bring it up. But I did try and keep the focus on, I didn't talk about unemployment benefits and things like that because they're not so relevant to investors and business owners, right? They're more relevant to working people and employees, right? So and then at the end, I'm going to go over some just general tax planning strategies and issues for investors. I'll talk about that at the end because again, I felt that would be of interest. So one thing I didn't address in my slides, and I realized after I'd already submitted them that I did not cover, was the Secure Act, which was passed in December of 2019. My office mate, Alan Pink, who talked to you last year, I believe, had said, oh, I didn't talk about that because it passed after I did my presentation. And so he kind of so they did pass that. The main change on that side was that they did raise the required minimum distribution age for IRAs from 70 to 72 for people that were not already subject to RMD requirements. So if you're 71 now, you still have to take an RMD, but if you're 69 or younger, then your RMD date has been changed to 72 instead of 70 and a half years old. Maybe 72 and a half, I don't know off the top of my head. So, and then they also did make some changes to the stretch IRA provisions, which were a little unfortunate for some people that like to do multi-generational financial planning with their IRAs. I'm not going to go too deep into that, but you can always reach out with any questions after the presentation if you have them. So, but I did want to just cover that, mostly that the RMD date has changed. So they did also make a couple changes to employer-sponsored plans. The most welcome one for my clients was that you can now open a 401k plan.
Hear.
You can't hear? Hello?
We could hear you fine.
Oh, okay.
Let's see. Who said they can't hear? Hello?
I don't know. Should I just keep going?
Yes, I believe so.
Okay. So I got a little derailed. Oh, you can now open a 401k plan after the end of the calendar year, which before you could not. So for some of our clients that like to do retirement contributions, that gives them another option after December 31st that they didn't have before. So, so I'm going to just dive in. And again, as we come up with questions as we go along, please put them in the chat. The moderators will flag them for me and read them out. Then I'll try and answer them as we go. We are going to try and keep the questions to the topic that I'm talking about at the moment, I think, or have just recently.
I have.
So I see there's a question about Proposition 19. Unfortunately, that's not my area of expertise, so I'm going to punt that. I do stick to income taxes. I don't. That's more of a personal property and the estate planning question. And plus, it's a very new proposition, so I haven't studied it. So I'm unfortunately not going to be able to offer any information on that. So, okay. But anyway, so first we're going to talk about the Families First Coronavirus Response Act, which is HR 6201, which was passed and signed into law on March 18th. As I mentioned before, it mandates employer-provided leave for coronavirus-related illness or quarantine. There are tax credits that from the government, the federal government, that cover up to 2 weeks of this paid time off, up to certain limits, but they're pretty generous, and for most small businesses, this wasn't an issue. And then there's also a slightly less credit, a smaller credit that covers 2/3 of the cost of time off to care for other people that have the virus or are under quarantine. And there was also a mandate for offering unpaid time off for the same reasons if the 2 weeks isn't enough. And importantly, they also offered these credits for self-employed individuals who may not even have employees, which is unusual. So that was something that I felt was worth mentioning, is that similar to that there's these credits to offset the cost of the time off, there is a similar credit for self-employed people to cover their time off, although I haven't actually looked into how they calculate that. I assume it's based on the average monthly income like they did with the PPA, or PPP, sorry. So this act overall didn't really have a lot for investors in it, but I did want to kind of mention that those were the provisions of it. So one other thing that's not actually part of it wasn't part of these acts, but it's been around for a long time, but it has become highly relevant to a lot of people, so I did want to go into it a little bit, is the IRC means Internal Revenue Code, Section 139, Employer Disaster Assistance. It's a mechanism for employers to give additional money to their staff to cover increased costs for a variety of things, in terms of like including working from home, additional housing costs, et cetera, during a federally declared disaster. And since the coronavirus pandemic has been a federally declared disaster for a long time, this is something that has been applied. I've used it in my own business, and many of my clients have as well. It allows a business to make non-taxable, non-accountable, meaning that the employee does not necessarily have to submit receipts like they would normally have to in order to get a non-taxable reimbursement, as long as the amounts are reasonable. So, on March 16th or so, when the Santa Clara County had said, hey, everybody needs to go home, and all of a sudden we're working from home, I used this provision to issue some reimbursements to my staff to kind of offset some of the costs that they're now having to absorb out of their home, using their own personal equipment and internet and cell phones and stuff. So that was a way to kind of do that. And then, again, as long as they're reasonable, you can't give someone like $3,000 a month and say, no, this is to offset costs without accounting for it. But if it's, $100 or $200 a month or whatever is reasonable for the circumstances, then that can work for you. So, but again, they're non-taxable to the employee and deductible by the business. And this is about one of the only places where you can do that without having to account for that money. Normally, if you give a non-accountable reimbursement to your employees, it is included in their W-2, and then they have to worry about, well, up until 2017, they could deduct it potentially as an itemized deduction, and now they're just out of luck. So anyways, are there any questions so far? Okay. So the more comprehensive and relevant to you, I believe, act was the Coronavirus Aid, Recovery, and Economic Stability Act. So that's what the CARES Act stands for, that I couldn't remember earlier. So as I mentioned, the government, they love making acronyms out of their acts. So, but the CARES Act was a couple weeks later, on March 27th. It had a lot of provisions that impact individuals and smaller businesses. The most famous, of course, is the economic stimulus checks, the economic impact payments, right? So which is what the IRS calls them, EIP. Everyone else calls them stimulus checks. They're up to $1,200 per individual and $500 per qualifying dependent. Like the media has not wanted to talk about anything but that since then. So I'm sure you've all heard about it to death. And as well as I keep seeing articles almost every day about when's the next one coming, even though no one's ever actually talked about sending out a second one. But it did change some IRA rules that we'll go over. This is basically an overview of what's coming in the next several slides. So I'll be going into more detail on all of these things. So it changed a couple of the employer retirement plan rules, changed charitable deduction rules for 2020 and beyond for one thing, provided some extensions of time to file and pay, making this tax season the one that never ended. It just basically went straight until October 15th instead of stopping in April like normal. So yeah, obviously we had until July 15th to file most returns and pay most taxes that were due between April 15th, 2020 and July 15th, 2020. So that gave everybody additional time to cope with the changes to their workplace and their finances. And the IRS also had suspended administratively, not as part of this act, most collection efforts during this time, as they recognized that a lot of people were having a lot of uncertainty and turmoil in their finances. So they modified net operating loss rules and business loss limitations that had changed during the Tax Cuts and Jobs Act, which you'll see me refer to frequently in this presentation as TCJA. So that stands for the Tax Cuts and Jobs Act of 2017, which was the giant tax bill that was passed in December 2017 that changed a lot of the tax rules carrying forward from 2018. And so some of the rules that had applied before 2018 now do apply again for 2018 to 2020. We'll go into a little bit more detail about that. So they did also create the Paycheck Protection Program loans and created also employee retention credits, which almost nobody's using because everybody used the Paycheck Protection Program loans instead. So, so these are all things I'm going to go into as we go through the following slides. So here's Uncle Sam with his wheelbarrow full of money. That's basically what they did. They just shoved it out. They sent it out to a lot of people that they later said shouldn't have gotten it, and they didn't really have the authority to correct that. So the IRS is a little bit miffed about that. And in particular, there was a lot of media attention paid to the fact that so the mechanism that the IRS used to determine who got this was that they would base it off of, because it's income restricted, right? They would base off of your 2019 return if you had filed it, and if you hadn't, they'd base it on your 2018 return. And so there were unpredictably a lot of people that had filed a tax return in 2018 but died that year, right? And they got these stimulus credits because there was a 2018 return on file, and if their income fit the profile of who qualified, they would get these checks. And then the IRS came back and later said, oh, well, you're not really supposed to get those, send the money back. But they kind of basically are asking pretty please because there isn't really any authority built into the CARES Act for them to enforce collection of this money once it's out, you know. So so some people got it that may not have gotten, you know, may not have been supposed to get or intended to get it, but you know, Congress writes these rules and they shove them through and pass them sometimes without fully considering the contents, and I think this is one of those items. Another issue in contention is whether imprisoned people qualified for it or not. I think that's still in court, and I don't actually know how that's been resolved. So another issue that was is that, you know, they were trying to make sure that as many people got these payments as possible. And so they said, okay, if you don't have to file a tax return and therefore didn't file for 2018 or 19, you know, here's a tool that we'll put on our website, although not until May, saying to give us your information of how to get us this money. But they also automatically sent it out to people that are receiving Social Security or SSI payments. And so we did see some circumstances where like survivors benefits, right, where if someone dies and they leave behind minor children and a spouse, even though the spouse would be filing for and claiming their minor children, and therefore the children would normally qualify for the $1,200 payment because they were receiving SSI or Social Security survivor benefits, they were getting it. So, and then again, the IRS doesn't really have a way to collect overpayments. So, and actually one of the things you can see on the bottom is that I say it trues up, but does not true down. The reason I say that is because it is a credit on your 2020 tax return that they were trying to pay you in advance based on the best information they had at the time they issued the payment, right? And so you're reconciling this credit on your 2020 tax return. But if you got more than you were supposed to based on your 2020 income and dependents and everything, you don't have to pay it back. But if you should have gotten more, you will get it, right? And so that's why I say it trues up but does not true down. So you can get more when you file your 2020 return, but you can't pay back any excess if you should have gotten less. And so, you know, if these people are, you know, they're dead, right? Or they're dependents and they're getting this money, there's really no way for the IRS to collect it from them. So they say that you're supposed to send it back. Some people did. I think a lot of people did not. So anyways, the credit was $1,200 per taxpayer or $2,400 for a married filing joint couple, plus $500 per dependent under the age of 18. And then it is subject to income limitations of was it $99,000? Yeah, I think it starts to phase out at around $75,000 for an individual or $150,000 for a married couple, and then $99,000 it goes away completely. So so that's what I meant when I said they were basing your eligibility on this for based on the return that they had on file, even though what actually qualifies you is your 2020 taxable or your adjusted gross income, right? So there were people that had a lower AGI in 2018, and therefore it was beneficial for them to put off filing a return until they got this payment, and then file 2019. And there were some that were the other way around as well, that 2019 was a lower income year than 2018, and therefore they wanted to rush and file this before the IRS issued those payments. So there was a little bit of planning that we could do. It's not a huge impact, but it's money. You know, it's well, I can't say it's free money because it's coming from the government, which comes from our taxes, but it was a big rush to maximize this benefit as much as possible. So are there any questions about this?
The only question is an IRA, which I think is more appropriate on the next screen.
Yeah. Okay. So for Congress did waive the required minimum distribution or RMD rules for 2020. You're not required to take a required minimum distribution, even if you would normally be required to. And they actually had created a window later on that if you had taken it before this act was passed, because a lot of people just take it in January and go, okay, now it's done, right? You were able to return it to your account and not pay tax on it. But it would have had to been done by August 31st. So if you didn't know that already, unfortunately, this information does not do you any good. So, but they did have, right, they did waive the requirement for the RMD for 2020. So that and this did also apply to employer accounts and inherited IRA accounts and Roth IRA accounts. So anywhere that would be normally required to make a distribution, you were allowed to not have to take it this year, and therefore not have to pay taxes on it, and not have to take money out of your portfolio in investments, which back in March and April were looking pretty bleak for most people. So
the question is regarding the RMD next year and going forward. The specific one was an inherited IRA under a 15-year distribution at year 6. Would you skip would next year start at year 6 or year 7?
I actually don't know the answer to that, unfortunately, but the normal RMD rule would apply. That's actually a kind of an edge case, and I hadn't run across it, unfortunately. I'm sorry, but I can't answer that. But please maybe shoot me an email after the presentation. I'd be happy to research that and get you the answer.
For regular IRAs, it just starts next year with the standard RMD table, right?
Exactly, yeah. The normal RMD that would apply for 2021 will apply. But what I don't know is that you know, hey, you're on a 15-year payment plan. Which year does that count as? I don't know the answer to that, unfortunately. So this is big. You know, coronavirus-related distributions. There's quite a lot of planning that can go into this. So I'll spend a little time talking about this. But you know, there's going to be everybody has their own individual circumstances, and so you know, everyone's going to have their own answer, right? So that's to it. But the coronavirus-related distributions is a provision of the CARES Act that allows taxpayers who are affected by the coronavirus, and we'll go over who that is in the next slide, right? To take out up to $100,000 from a retirement account without the normal early withdrawal penalties if you're under age 59 and a half. And also the default treatment for this distribution will be that you'll pay tax on it a third in 2020, a third in 2021, and a third in 2022. So you can take out the money now and pay tax on it later, potentially. If for whatever reason you'd rather pay for tax on the whole thing in 2020, you're allowed to do that as well. You just make an election to forego that treatment. So, and for a lot of business owners, their income is down this year, and they may decide that it's better to, or you know, hopefully they may even have a loss, or maybe even a large loss, and they could say, well, I'd rather use that loss to offset my coronavirus-related distribution instead of paying tax on a third of it next year when hopefully business will be better, right? So that could be one reason to do that. So it doesn't have to be 100,000. It's just any amount up to 100,000. I believe when you make the withdrawal, you're supposed to tell the institution that it's a coronavirus-related distribution so that they can code it appropriately, I think. But if you've already taken one of these distributions or taken any distribution and qualify for it to be treated as, you probably, I imagine, can call your broker or your custodian and ask them to code it like that on the 1099 when it comes out. So, because they haven't, of course, mailed anything out yet. So, one of the big things about this, though, is that, you know, if you have cash sitting in a taxable account and have it something that you can put in a retirement account, there's nothing prohibiting you from converting this distribution to a Roth IRA. So I went over, you know, that was one of the first things I kind of thought of when I read the Coronavirus Act. I went through it very closely, and there's absolutely no requirement that you use this distribution for any specific use. And so anything that you could normally take an IRA distribution out for, you can use it for this, and that includes a conversion to a Roth IRA account. So where this really gets interesting is, I think, another slide or two down the road, which we'll go into. So this is kind of this could be a power move for your investments if you're in a position to pay the tax on a conversion like that, where you can convert up to $100,000 per spouse and pay tax on it a third. We did this once back in, like, I want to say 2008 or 2009, where you could split the Roth conversion tax over 2 years, but this time it's 3. I know, of course, if you don't have the ability or inclination to do that, then you can also use that money for any other use. I did have at least one client take money out in order to help pay for a house for the kid. So again, there's absolutely no requirement that you account for this money or spend it for any specific purpose, as long as you qualify. So
There is a question about the CARES Act. The parents are on Social Security, which is their main source of income. They did not receive the $1,200, $2,400 checks. What can they do now to claim it?
They can file a 2020 tax return and claim it if they did not get it. However, for Social Security benefit or recipients that don't normally file a tax return, it was sent by direct deposit, not a check. And so you may have them check their bank account. I mean, assuming that their benefits are paid by direct deposit, the economic impact payment would have been also sent to that same account. So I would have them check their bank account because one of the provisions of these payments is that they were not offsettable by almost anything. Normally, if there was like a refund coming from you and you owed back taxes or something like that, or sometimes even if you had an unpaid parking ticket, right, or unpaid car registration, then your refund can be partially or fully intercepted, right? This specifically was not, except for anything other than back child support. So if you had a taxpayer who owed back child support, then the economic impact payment should have gone towards that. But short of that, it should have come to them. And it was sent to most Social Security recipients who, my understanding is almost all of them elect to get their money electronically by direct deposit. Then that economic impact payment would have also come via direct deposit. So
it was stated that they didn't get it to their checking account, and almost everyone has to have it by their checking account, because when my mother-in-law filed it, you had to prove it was a hardship not to have it electronically deposited.
Oh, I wasn't aware of that. I'm only 39, so I haven't had to deal with these things yet.
So the major option would be to file, even though they don't have taxes to pay, would be to file a 2020 tax return.
Yes. The 2020 tax credit that this is paying in advance is a refundable credit, meaning that it can lower your tax below zero. So if they did not get it and they were eligible for it, you may still be able to go on the IRS website and give them your use their non-filer tool. I know there was a deadline for that coming up soon, but I didn't pay a lot of attention to it because all of my clients had already taken care of this. So, or if they weren't filing, they weren't my client. So I think it was probably around now, though. So they may still be able to go to the IRS website and use their non-filer tool to provide direct deposit information for them where to send that. Other than that, though, they can file even a zero return for 2020 and claim this credit and get it as a refund on their 2020 tax return, even if they don't have a filing requirement. So that would be my suggestion. So.
There was also a question about the 1/3 over 3 years, that you could do a conversion of 1/3 over 3 years, but this allows you, is the difference currently that you can do the full conversion now and pay taxes over 3 years?
Up to $100,000 of coronavirus-related distributions. So we'll go over in another slide or two what qualifies someone to take one of these distributions. So it's not a blank check that you can do an unlimited amount for. It is only up to $100,000 per taxpayer. So in a married couple, you could do one each, up to $100,000 each. And on that $100,000, up to $100,000, they would be able to pay tax on it ratably over 3 years.
With no RMD requirement, is it a good time to roll over a traditional IRA? And does the rollover just add to AGI?
Yes, the rollover would roll over to AGI, would increase. When you do it pre-tax to post-tax conversion, you do pay tax on the converted amount. If that amount or some of it qualifies for this treatment for the coronavirus-related distributions, then that portion could be done over 3 years. So that can be a way to kind of spread out the tax pain for doing that conversion. So, but there's actually even a better, some better news on this, and a better and even more powerful strategy if you can afford to do it. So, and we'll talk about that in a moment. So,
okay, RMD divisors. Do you want to address that now or later? Did they change?
I'm sorry, what?
The RMD divisors. The IRS was talking about changing them to reflect longer expected lifespans. Have they changed?
I'm not aware of that, actually, so I don't know whether they've done that or not. So,
okay, that's all the questions.
They've been on my radar. I apologize. I believe there was something about that in the Secures Act when they raised the age for the RMD. It would make sense that they would also adjust the actuarial tables, but I don't know whether that's happened or not. So this is the second part of the coronavirus-related distribution equation, is that not only can you spread it over 3 years, then within 3 years you can actually repay it into any retirement account, any qualified pre-tax retirement account, and it'll be treated as if it was indirect rollover, meaning that you never pay tax on it, right? So this is where you can do some really powerful tax planning if you are approaching retirement and have enough cash to fund this, right? Because you know, what you can literally do is roll over up to $100,000 into a Roth IRA, and then put that $100,000 back in an IRA, and then roll it and then convert it again, right? So you can really turbocharge a Roth strategy this way if you have the means to do so, which I understand not everybody will, but for those that do have the assets to do that, it can be a tremendous way to move a huge amount of assets over to a tax-free growth account that doesn't have required minimum distributions, and which you can pass on to your heirs tax-free if that's your desire, right? If you have elected to spread that tax over 3 years, and in year 2 or 3 decide that you want to put the money back in your account, you can amend your return that you reported that 1/3 in tax on, or however want return of returns, and claim a refund for any taxes paid. So that wasn't actually made really clear when they passed the law how they were going to administer that. The IRS did come out with some clarification later that said this is how you do it. So, if you need the money now, due to the pandemic or any other reason, and later on have the means to put it back, you can do so, recontributing that money to your retirement account, and either having it grow tax deferred if it's a pre-tax account, or tax-free if it's a post-tax account. So that can be something that people can do if they're just if they're in a tight spot right now. So coronavirus-related distributions must be made by December 31st of this year. So there's a window to take advantage of this provision, and once it's expired, then this goes away. So it's an opportunity for some that can afford to take advantage of it, and whose circumstances make this beneficial, right? So because obviously not everybody is as high on Roth IRAs as a young person like me. So the closer you are to retirement, or RMD age, then then sometimes it makes a little less sense. So, but for taxpayers who can and benefit from this, it can be very powerful. So, any questions about this slide?
I'm not seeing any additional questions. Oh, yeah, I'm not seeing any additional questions.
Okay. So this is who qualifies for this, right? You know, this is that if you've been diagnosed with COVID-19 or whose spouse or dependents have been diagnosed, a taxpayer who experiences adverse financial consequences due to COVID-19, including if their work or business income has been decreased as a result of the pandemic, or their spouse, right? And the spouse piece was not actually initially clarified either, but they have come out and said that this is the case, right? Because I mentioned earlier that one of my clients had decided to take a coronavirus-related distribution to help their child pay for a house, right? And the question was that, you know, the spouse that had been impacted, she was a medical professional, and her office hours had been cut drastically due to the pandemic because she didn't work in a hospital. And so, but the other spouse was the one that had the retirement account, right? And so at the time they were like, I think this works, but I'm not sure. And then they later on, shortly after, came out and said, yes, this is fine. If your spouse has had their hours or business income reduced because of the coronavirus pandemic, you're allowed to take advantage of this as well. So, and then also, if you or your spouse were unable to work or had reduced hours due to lack of childcare during the pandemic, that would also qualify. Obviously, everybody's schools shut down pretty much across the country, some of which are still not back in session in live classes or in-person classes rather. So they did allow for that as well. You know, that if you had to stay home and couldn't work because you don't have childcare, that you would also qualify for this provision. So. There's similar, some changes to employer plans as well, such as 401k or 403b, 457 if you work for government. That, you know, normally you can not, if you're borrowing from the loan, assuming your plan allows for it, you're not allowed to normally borrow more than $50,000, right? So that was temporarily increased to $100,000 or whatever the vested benefit is, whichever is smaller, right? Any loan payments can be deferred up to 1 year, but interest accrues, although most people don't care because they're paying the interest to themselves, right? And I did want to highlight that the CARES Act says may and can, doesn't say shall or must. And so each employer is going to have to decide whether their plan supports this type of treatment and whether they're going to make they're going to make the change for this or allow their employees to take advantage of that. So back in 2017, when they were talking about the Tax Cuts and Jobs Act, or the TCJA, there was a lot of attention paid to the, I think, $10 trillion limit, right? Like you couldn't raise taxes by more than $10 trillion or raise the deficit over a certain period of time. And so they had to put in some things to pay for some of the changes that they made, right? And one of the changes that they made to pay for some of these was that net operating business losses, which typically would have been carried back automatically 2 to 5 years, depending on the type and timing of it, and reduce taxable income in prior years so that you can get a refund now. The idea had been, hey, if you experience this loss, cash may be tight, and therefore we're going to make it so that you can take advantage of this loss and get some of the taxes you paid in the past back now or within a couple months, rather than having to wait for however many years you file your tax return and can fully get the benefit of that loss, right, or tax benefit of that loss. So starting in 2018, the NOLs, or net operating losses, were only carried forward. And so the CARES Act has suspended this change retroactive to 2018. So there are some taxpayers who had a net operating loss in 2018 or 2019, which would have only carried it forward, who may revisit this if they want to and amend those returns and carry the loss backwards in order to claim a refund money now versus money later. Now, if you had very little taxable income or paying tax at a lower rate in past years than you are expecting to carrying forward, then it may not make sense for you to do this, but it is an option. So it's not compulsory. It is a choice that you can make. So any net operating loss from a tax year that starts for a tax year beginning after January 1st, 2018 and before December 31st, 2020 will qualify. The reason for that language is because some businesses operate, or trusts and other entities operate on a fiscal year that does not end in December. So they're saying, okay, if your fiscal year ends or it begins on July 1st instead of January 1st, and as long as it's between July 1st, 2018 to July 1st, or to the year that starts on July 1st, 2020, that'll still qualify. So again, the change is retroactive, which I don't know about you guys, but I really love it when Congress changes the tax laws after the fact. It just makes my day. It's just they do that all the time, but this one I think was probably warranted. They're trying again to allow people that are impacted by this pandemic to hopefully get some money in their pocket relatively quickly. So when you make a claim for a net operating loss, you usually do it on a form that's called the application for prompt assessment or something like that. You're supposed to address it within 90 days, which for IRS timeline is not bad, for an amended return. So normal amended return can take 8 to 12 weeks to process. This is 90 days, which is less than that. So, and I had one client that we did that for, and I think it took them about 6 weeks. And so they actually, because the IRS mail rooms had been shut down during this pandemic and are still backlogged to a certain extent, they actually opened up a fax line that you could send these claims to for refunds for the NOL carrybacks, which was unprecedented or maybe unusual. I don't know, but it was. I felt it was nice. I like to be able. I was able to fax that in for my client, and he got his refund in about 6 weeks. So rather than having to wait for it to be opened and processed by hand. So, anyways, are there any questions about this so far? No? Okay. So similarly, for business losses limitations that also had been limited before 2018, and the Tax Cuts and Jobs Act imposed a requirement or a limitation that you're not allowed to use a business loss to offset more than $250,000 of unrelated income, or $500,000 for a joint return, with any amount left over carries forward as a net operating loss. Before, this limitation did not apply. So any amount of net operating loss, as we've seen in the news, can be carried forward. It used to be up to 20 years to offset income in future years, up to 100% of their income. So, and so the CARES Act, had suspended this provision for 2018 to 2020, and also they had a provision that permanently exempts losses from farm income from this limitation. So I think the farm issue was an oversight when they drafted the Tax Cuts and Jobs Act. It was another extremely extensive act that made a huge number of changes to the tax code that was not perhaps properly considered before being passed. So there were some technical errors and oversights like this. I believe that the farm loss was one of them, and they took the CARES Act as an opportunity to correct that. So.
Any taxable distribution from an IRA raises your MAGI for for Medicare, correct?
I believe so, yes.
Okay.
Yeah. So that's again a not directly tax-related issue. So I'm not, I'm of the opinion that the rules for Social Security are at least as complicated as the tax code. So, and I have a full-time job keeping on top of the tax code. And again, since I'm only 39, I haven't had to deal with the labyrinth and Byzantine provisions of the Social Security office and the way Medicare premiums are calculated. So, but my understanding is that any income on your tax return will increase your modified adjusted gross income for the IRMA purposes. So if I have a client that is doing a large conversion that's of retirement age, or who's enrolled in Medicare, or is like retiring and selling a bunch of stock or paying out a bunch of deferred compensation, I always let them know, just so you know, you're going to get this letter from the Social Security Administration, letting you know that your premiums from Medicare are going to go up. So sometimes they can appeal it, sometimes not. My mother-in-law a couple of years ago did a large conversion, and I told her this was coming, and it did. And I told her she could probably appeal it, and she tried, and they came back and said, no, but we're going to give you your money back anyways, and we're not really sure why, but it got the result that we were looking for. And so that was fine. So, because oftentimes if it's just a one-time event, like I sold my house and had a big gain, then that's not really something that should, logically or rationally, permanently increase your Medicare premium. So
For 1 year, it from what I've read, because I did it.
Yeah. And since it's just 1 year, that sometimes they're not willing to adjust it. But I've had a couple of clients that have been successful, and I always tell them it doesn't hurt to ask. You're retired now, you have a little bit of time. You just write the letter and send it in and see if they give it to you, right? So, anyways. Although I guess there's probably plenty of retired people on paper that are much busier than me, so I guess I shouldn't say that. So, so again, this was this is kind of two pieces of a net operating loss treatment. One is whether it gets carried forward or back, and this one is how much income it can offset, right? And so it's for 2018 to 2020, it's no longer, this limit doesn't apply. So if you had a year where you ran into this limitation in 2018 or 2019 or 2020, then you can, or 2018 and 2019 on a return that you already filed, you can amend in order to correct that, since it was a retroactive change. So those were the two main retroactive changes that Congress made as part of the CARES Act, was this treatment of the NOL, the net operating loss, and the business loss limitation for 2018 to 2020. They also made a change to 163J, which is a limitation that the Tax Cuts and Jobs Act introduced on the deduction of business interest. That's a little technical, and I don't think that it applies to many businesses that any of you are going to have to deal with where you'd have to worry about that. So, but that was also another thing that was changed retroactively. If for whatever reason you did run into that, you can possibly amend your return and get the alternate treatment for that. So. This is a technical correction for the Tax Cuts and Jobs Act. As I mentioned a couple times, it was a little bit hastily put together, and there were some errors in it that didn't get caught until after the fact, and this was one of them. So the Tax Cuts and Jobs Act had changed the depreciation rules for property that a business buys, equipment and vehicles, etc., right? And before the Tax Cuts and Jobs Act, there was the classification of property for like retail and restaurant locations, right? That was called a qualified improvement property, which was a tenant improvement or leasehold improvement that was for one of these businesses, and it got a shorter depreciation life over than normal, right? So depreciation is the mechanism for tax purposes that we use to claim a tax deduction for property that you buy, right? So if you go and you buy office supplies, that's an expense. That's something that you just used once and it's done. If you buy a piece of equipment like a computer or a piece of manufacturing equipment or a vehicle that you use over a number of years, you're required in general to depreciate that over a number of years. And so for business real property, including things that are part of it, like improvements, it typically was a 39.5-year depreciation life, meaning that you would get a very small deduction per year and you'd have to get the benefit of the cost over 40 years. So a number of years ago, Congress said, okay, well, that's not really reasonable for some of these businesses, so we're going to give them a special classification of 15 years. The Tax Cuts and Jobs Act did not preserve that treatment by mistake, and therefore it reverted to 39.5-year depreciation life. One of the other changes that Tax Cuts and Jobs Act did was that they made almost everything eligible for almost immediate deduction, right? But only only for assets with a certain depreciable life, right? I think it's 15 years or less. And all of a sudden, this property is now 39 and a half years and didn't qualify for that. So not only did they lose they have the slower depreciation than they used to, but now they weren't eligible for this accelerated depreciation claim. So Congress actually didn't intend for that. And a number of senators had written to the IRS saying, well, can you just like treat it this way? And the IRS said, no, we have to administer the law as it's written. If you want to fix it, you got to pass a new law. And so they finally did after 2 years out of wondering if they were going to address this. They did that, and it did also go retroactive to 2018. And so, as we've been talking about, you may need to amend. You may want to amend your 2018 or 2019 return if this impacts you, because it would allow you to potentially claim a 100% deduction for what your improvement cost was, and get some money back for 2018 and 2019. So, any questions? So there's a question from Phil asking about whether the qualified improvement property relates to rental property for roof replacement. It's typically for a commercial business, like that deals with the public. So the roof is a whole nother ball of yarn because the taxpayers and the IRS have been arguing about it for a long time because there are a number of property owners who believe that a roof replacement is a repair, not an improvement, because the definition of a repair is something that preserves the functionality and value of a property rather than enhances it, right? And so if you're remodeling a bathroom or a kitchen, that's a pretty tough sell, right? But if you are to say that it's not an improvement because, whatever, but if you, like, say, have to repair a leaky pipe, that's obviously a repair, right? You have to replace a toilet because it's leaking, that's a repair, right? But so the roof, because it's large and expensive and usually lasts for 40 or 50 years, the IRS had always said, no, that's an improvement, right? That's not. And some of the landlords have gone to court and say, well, no, this is a repair because if I don't do this, my property is going to get wet and it's going to be damaged and get lost. So even though it's not qualified improvement property, there are some arguments that it's just a deduction as a repair. I believe that some people have won in court and some people have not won. And so how aggressive you want to be on that is going to be between you and your tax professional and your preparer. So you can always look at the circumstances and determine what the difference is. So, but the answer to the question is no, a QIP is not apply for a roof. So a roof would typically be depreciated over 27 and a half years for a residential property or 39 and a half years for a commercial property. So. Move on to, they made some changes to the deductions for donations. For 2020 alone, there is no limit for cash donations. So usually if you're making a donation, you're not allowed to deduct more than 60% of your adjusted gross income from most charities, right? Which means if you had a $100,000 AGI, you can't deduct more than $60,000 of charitable deductions. Most people, this is not an issue, right? But for 2020 alone, they did remove this cap so that if there was someone who had potentially had lower income this year and was feeling charitable because a lot of these charities are hurting, then you would be able to deduct up to 100% of your income, right? And in any case, anything that you don't get deducted in the current year carries forward typically for up to 5 years. So if you make a very large bequest to a certain organization in 1 year and you can't fully deduct it, then the balance would go over to the next year and be deducted in that year, assuming you have the AGI to support it. So, but it does only apply to cash donations, and it only applies to qualifying charities. So, and when I say qualifying charities, then typically charitable remainder trusts or donor advised funds don't qualify, and there are a couple others, but those are the main ones, right? And donations of property, such as appreciated real estate or stock, or donations to Hope or Goodwill or Salvation Army, those don't qualify for this additional. Those are still limited to 60% of your AGI. So, but I don't know about you guys, but I've been hearing from a lot of my charities that things are looking pretty dire for them this year. You've heard from the Monterey Bay Aquarium a lot, and they're saying, we haven't been able to open and have any sort of ticket revenue for, since March, and so they're hurting, and a lot of the charities as well. And as their donors, financial lives are in flux, a lot of the donations have dried up. And so this is a way that Congress is trying to help those charities, I think, be able to collect a little more from some of their wealthier donors than they might otherwise be able to. So.
The limitations on of income for stock and property remain the same, right?
Correct. Generally, 50% for state purposes, California purposes, anyways, and 60% for federal. So.
I think I just muted you.
That's fine. I was able to unmute.
Oh.
So another thing that they added, which is of minor interest to some, is that the CARES Act did add a $300 up to $300 deduction above the line as an adjustment to income. Above the line means above adjusted gross income instead of. So typically, if you look at a tax return, you have a section for income, then you have a section for adjusted gross income, and then after adjusted gross income, you factor in your itemized deductions, right? So when I say above the line, it means above the AGI line, right? So this is a deduction of up to $300 per year of cash donations to qualified charities if you don't itemize deductions. And so it is useful to some taxpayers who might not be itemizing anymore, especially after the increase to the standard deduction amount in the Tax Cuts and Jobs Act, as well as the $10,000 limitation on deductible state and property taxes, right? So, the itemized deductions for a married couple used to be around $14,000, and you could do that in property tax around here, right? And so, but now it's about $24,000 for a married couple, and if you don't have a lot of mortgage interest deductions and you're capped at $10,000 for property taxes and state taxes, some people that itemized before are no longer doing so, right? And so they say, okay, well now, if you make donations, you can still deduct up to $300 if you're using the standard deduction. Obviously, if you're itemizing, this doesn't apply to you, right? But this change was permanent, which most of the changes to the tax and the CARES Act were not permanent. This is one of them that was kind of out of left field, probably didn't have anything to do with the coronavirus, but they may have been somebody's pet provision they were trying to add for a while. I'm not sure. So, but this is nice because then if you're donating to your charitable causes but don't itemize, you can still get some benefit from it. So even if it's not a full deduction. Also, $300 per year is regardless of filing status. If you're single, it's $300. If you're married filing joint, it's $300. If you're head of household, it's $300. Most of the time with these type of limits, they scale with the filing status, but this one does not. So. Any questions? All right. Perhaps of interest is the IRS released some proposed regulations for the 1031 exchanges. The 1031 exchange is a tax code provision that allows investors and business owners to sell business use property and potentially defer the gain on recognizing the gain on that sale by reinvesting that money directly into a like property, right? So 1031 exchange is often referred to as a like kind exchange. Before Tax Cuts and Jobs Act, this was pretty broad, right? To the point where even if you had a business vehicle and traded it in, that was a 1031 exchange, right? Because you were putting a business use vehicle, you're selling it and trading it in for another business use vehicle, right? So, but the Tax Cuts and Jobs Act made a change to that where only real property now qualifies for the 1031 exchange treatment, which was kind of a big deal because when you sell a piece of real estate, which is the most common thing we see for a 1031 exchange, even before Tax Cuts and Jobs Act, oftentimes it's not just a building that you're selling. You're selling appliances and fixtures that you've added to it over the years, and these are considered not real property, right? In a lot of cases, and so there was assumption that if you did a 1031 exchange, you'd still have to recognize some gain on that because they would be considered what they call boot, like you get it to boot, right? So they call it boot. And the IRS in June released some proposed regulations. So this wasn't actually a bill from Congress. This was just the IRS issuing their opinion saying that certain de minimis personal property that is commonly included in that type of transaction that doesn't exceed, I think, 15% of the value of the property that's being sold can be considered part of the 1031 exchange, which was a relief because, again, if you're selling a duplex or an apartment building, right, and you have a laundry facility in it, right, then before, between 2018 and when this came out in June, you would have had to say, well, the portion of the sale price that was allocable to those equipment doesn't qualify for the exchange. And now the IRS is saying, yeah, it probably does, right? They could still do a little bit of more clarification on this, but it's better than we had before. So, are there any questions? Nope, I don't see any. Okay, so that's kind of the end of my 2020 update portion of my presentation, and the second half is going to just be about taxes in general for investors and what they pay. So I'd like to take this opportunity to really just check: are there any questions about what I've talked about so far with the CARES Act and the Families First Coronavirus Response Act? So
There is one question. Does the 300 above the line charitable contribution change with inflation going forward or not?
I do not believe it does. I think it's just $300. So
That's the only question I'm seeing in chat.
okay. If someone else thinks of some question later on that relates to the first part, that's fine. You can still ask it. But I did want to just kind of encourage people to speak up now if they have a question about what I've talked to. I did, again, kind of do things at a high level, and I tried to focus on the items that I felt would be most relevant to my audience. So if there's something that you heard about that I didn't cover, or there was something that I covered that you didn't quite understand, please feel free to speak up. So in the absence of any further questions, even though it's a little bit earlier than the scheduled break, I think this is a natural time to stop for a few minutes. Would that be okay? Okay, we can start. The second half, as Lynn mentioned, and obviously as you can see, is the on general taxes for investors, and I'll go into a little bit of detail on some of the ideas that we use when we're proactive tax planning to save our clients some money. Pardon me. So, I mean, this is probably pretty basic for most of you, but I want to just kind of lay out what are you paying, right? You're going to pay federal income tax, of course, on your non-special income, which is basically anything that is income that doesn't get a special tax treatment, right? Excuse me. Is there so what we call ordinary income, which is your wages and interest, ordinary dividends, short-term capital gains, rental income, etc. It currently has a federal income tax rate maximum of 37%. That's reached at approximately $500,000 or so for a married couple of taxable income. So after your deductions. So long-term capital gain and qualified dividends get a special tax treatment. You can pay either 0, 15, or 20% for federal purposes, depending on where your income level is. There's special tax rate on long-term capital gain from the sale of collectibles and precious metals, which is a maximum of 28%. Higher income taxpayers will also pay net investment income tax of 3.8% on your net investment income. There's another slide about that, so we'll go a little more detail. However, that's been around since around 2008 or 2009 as part of the Affordable Care Act. So most of you, I imagine, are pretty familiar with it by now. So, and then depending on where you live and where your investments are, you could also be state income tax. Typically, if it's real property in another state and there's a gain or taxable income, then that state will assert its right to tax that income regardless of where you live. Short of that, it's kind of hard for them to say that income is sourced to a specific state for other traditional investments. Although if you have like a K-1 coming from a business that you invested in, then that business may be doing business in that state and may pass through some income for other states for you. Anyways. So in general, these are the types of taxes that you're paying as an investor. So, well, really as a U.S. resident. So it kind of covers everything. So, as I mentioned, this has been around for a long time by now, but it's a 3.8% Medicare surcharge on taxable investment income that falls over the threshold of $200,000 or $250,000 for jointly filed returns. What that means is that if your overall income is $220,000 and $100,000 of that is investment income, then only the $20,000 that falls over that threshold for a single filer would be subject to that net investment income tax, even though there's more investment income than that. So I hope that makes sense. So it was part of the Affordable Care Act, as I mentioned. We call it Medicare surtax because that's really what it is. So it was a way for the government to collect more money to help pay for the Affordable Care Act. So at its core. So investment income is, going to be generally defined as it says: interest, dividends, capital gains. That part's pretty obvious. Business income if it's a passive investment, not if it's an actively run business that you are working in. So like if you have a K1 from a K1 is, for those who may not be familiar, is the way that a S corporation or partnership will pass through income to their individual shareholders, because those businesses do not pay income tax themselves. So a partnership would calculate its net profit and then divide out the income using K1s to the individual investors, and they would each pay tax on the income that's shown on the K1. So you may have a K1 from a passive income investment, and that would be subject to Medicare or this net investment income tax. But if you are running a business that just happens to be a partnership, or you're a partner in an actively participating partner in a partnership, then that profit would not be considered investment income because it's business income, right? So same thing for S corporations as well. So if you're a shareholder that gets income from an S corporation that you're working in and own, then that's not investment income for this purpose. So also the other exclusion is rental income is not investment income if you're a real estate professional, which we talk about later, right? But a real estate professional is basically someone who does real estate for a living, and there's a lot of criteria that qualify it, which again we'll talk about in a little bit. But if you do qualify for that, then your rental income is not considered investment income, just like the business income for an actively run business is not considered investment income. So if you have gain on the sale of property in one of these businesses, then that's also generally not going to be considered. If you have capital gain from the sale of business equipment in a business that you're actively participating in that's not a passive investment, then that gain will also not be considered net investment. It's not investment income for this purpose. So it's not really as complicated as I just probably made it sound. Generally, most people are just going to pay this tax on their interest and dividends and capital gains without too much complication. So, and again, this has been around since 2008, 2009. So I'm sure most of you have run into it if you're going to. So this is something that's new. And so some of you may be aware of it, and some of you may not be. But the Tax Cuts and Jobs Act, one of the provisions they created was IRC Section 1400Z for the Opportunity Zone investments. And this used to be, there's been various programs like Enterprise Zone type or named type of provisions that are similar to this before, and this basically replaces them. And so at its core, it's the government trying to encourage investors to invest long-term into areas that are not getting the investment that they need to develop, right? So when they created this provision, they told the states, hey, you're going to go through your state and figure out what areas qualify for this, right? And so the state would go through, each state went through and found out which tracts and areas were not performing economically the same as the ones around it, right? And so then they designated these as opportunity zones. So the government gave a whole lot of pretty rich benefits for investors who are willing to invest capital into the type of things that the government wants to encourage and leave it there, right? That's the thing, is that it's not a pump and sell opportunity. You need to leave it there for a number of years in order to get the maximum benefits of what they're doing, so, or what they're offering. So since the Tax Cuts and Jobs Act was passed in December of 2017, there's been a bit of a gold rush on a lot of these areas. So a lot of the low-hanging fruit opportunities have been snatched up already, but I'm sure, if you wanted to look into it and do your due diligence, you could find some opportunities as well. Surprisingly, large parts of downtown San Jose qualify as an opportunity zone. So, and there's been, I've seen many articles written about some of the developers that are taking advantage of that in a big way. So more commonly, just because of the complexity of these projects and the nature of what you need to do to comply and qualify this is pretty extreme, right? If anybody's done real estate development, I understand it's a tough thing to do in the first place, right? And then when you add in all these other requirements, it can be harder. So much more commonly than people individually participating in this, a lot more commonly is people are investing in funds or partnerships that are doing these projects and not doing them directly. So, so this kind of gives you some background of the opportunities. It doesn't actually tell you what those tax benefits are. So let's go to the next slide, right? So the incentives you get is that you can defer federal income tax on any capital gain from any source. We talked briefly before about the 1031 exchange, which would allow you to defer tax on real estate only, right? But this is for anything. If you sell Apple or Tesla and you have a huge capital gain, short or long term, you can invest that. You can defer the federal tax on it by reinvesting those.
Another card.
What's that? Okay, so you can defer the federal income tax on that gain within 180 days by investing it in an opportunity zone, right? So that's the first and immediate benefit. So you sell, and if you sell an investment for $100,000 that has a $10,000 capital gain, you only need to put in the $10,000 in order to defer the tax on it, and you can do it and you have 180 days to do this. So there is one little quirk of gain that's from partnership interest. A lot of investors that have investment partnerships and hedge funds, they'll get a K-1 and find out that they have a Section 1231, which is a capital gain from the sale of business assets gain that they don't know about, right? And so that gain specifically is deemed to have been paid to you on or realized on December 31st, regardless of when they actually made a distribution to you. So that's the one thing that's a little bit different. But in general, if you sell it today, you have until 180 days to elect to defer gain by investing in one of these projects, right? Which does mean that it can easily and frequently cross calendar years, right? So that is one of the things that you can potentially do after December 31st that would still help your tax bill for 2020, right? But it is something that, you have to investigate and, of course, do your due diligence like any investment and find out, make sure that the people that you're investing in know what they're doing and that the project is viable, et cetera, right? So, so any amount of capital gain that's elected to get this treatment within 180 days is the federal tax is deferred until 2026 or until you sell the investment, whichever is sooner. So if you are holding that investment, it goes until 2026. You don't have to pay the tax on that amount of money, right? I already covered that unlike a 1031 exchange, it doesn't have to be gain from the sale of real property. It can be from any investment or pretty much any source of where you can get a capital gain from. Even your home, if you sell your primary residence and have a taxable gain and aren't putting all of those proceeds right into a new home, you can use this in order to avoid income tax or capital or defer it rather. Sorry. In 2026, if you still own the investment, you'll only need to pay 95% of the federal tax that was deferred. So again, if you deferred $10,000 of tax, right, which is more like $50,000 or $60,000 of gain, right, then you would only need to pay 95% of that, and the remaining 5% would be forgiven. So the first benefit is deferral. The second benefit is forgiveness of part of the tax that was deferred. Now, I keep saying federal, federal, federal. In case you hadn't caught that, California wants nothing to do with this. So they do not conform to almost any of the Tax Cuts and Jobs Act, and they will continue to tax the initial sale normally when it's realized, and does not offer this deferment or forgiveness or the next benefit that I'm about to talk about in the next slide. Before I move on, are there any questions about this so far?
There was a question about a Roth conversion. Is it net investment income? It's regular. Okay.
No, because money coming out of an IRA is ordinary income. Regardless of what the income in the account was before it came out, when it comes out, it's always ordinary income, and therefore, and the Roth conversion is just treated the same way. It's ordinary income. It's not subject to the net investment income tax. That's a good question, though.
That's the only question in chat.
This is a smart group. They don't have any questions, so I'm impressed. I had built in some time for questions, and so I hope I don't run out of material. So the final and potentially most dramatic benefit of the Opportunity Zone investments is that if you hold it for at least 10 years before selling, you have no capital gain when you sell. So so you start off the Opportunity Zone with a zero basis, right? Because you've only, for federal purposes, you've only invested capital gains that you're deferring, right? Once in 2026 rolls around and you pay tax, then that's your basis, right? And if you hold the property for at least 10 years, then when you sell it, your basis for federal purposes is the sale price. So any appreciation that happened over the 10 plus years you've owned the investment, you don't have to pay federal tax on. So that's the potentially phenomenal benefit, right? There's some big money involved in here. Again, the government's trying to have investors put their capital in areas that they traditionally have not been, at least not to the amounts that the government thinks is necessary to make those areas grow. And they want the money to be there for a long time. So, you know, you can die. The rules are you have to either build a new building or buy a new business, you know, start a new business in one of these zones, or buy an existing building and spend at least as much as you paid for the building rehabbing it, right? So they're really stressing that they're trying to get you to develop the area and bring up the value and the economic activities, create jobs, and improve the area. And the reason this was such a gold rush in the beginning is because, okay, you go in this area that's a little bit underperforming, which means it's probably a little run down, and you buy these rundown properties and then you rehab them, and then if everyone else is doing that around you, then all of a sudden the property values can skyrocket in theory, right? And then when you sell this after 10 years, there's no capital gain. You're like, oh, well, that's no brainer, right? As long as it makes money and as long as you can tie your money up for 10 years, right? And as long as you find someone who does what they're doing with these, with the real estate development in general, right? So there are any number of funds. The first year in 2018, there was a lot of hesitation and nobody was really doing these because nobody knew. Well, first of all, the IRS wasn't really forthcoming with the rules about this. Congress wrote the law, but they didn't give a lot of details, as they usually do. And it took the IRS a long time, I think over a year. I think around January of 2019 is when they finally released some proposed regulations that kind of quantified some of these rules and how and what needs to be done to get this treatment, like for the companies that are doing these investments. So, but now there are any number of them. The trick is always, just like any other private partnership, finding one that is going to be run well and get you the return that you're looking for. But it is a tremendous tax planning long-term opportunity for taxpayers who are interested in that kind of investment. Although, if you are, I'm sure you already know all this, because it's been around for a couple of years now, and there's been a lot of talk about it for a long time. But I did want to kind of bring that up for those that may not have heard of it, because even someone that's not involved in real estate investment traditionally, or not in real estate development, could, like, again, you know, you look at Tesla and it's gone up how much this year, right? If you made a good investment and made a lot of money on it, and you sell, and then you don't want to pay the federal tax on that gain, and you're willing to reinvest that money for your, 10 plus years down the road, this could be something that you might consider that you might not have heard of, right? So the devil's always in the details. And again, the note at the bottom says as I mentioned before, California does not comply or conform to 1400Z. And so I'm not aware of any states that do, but I haven't actually looked. So because I live in California, mostly go California, but I haven't heard of any other states that do. So, so this is just strictly a federal tax benefit. So, but when you figure that your federal tax on long-term capital gain or even short-term capital gain can go between up to 23.8% for long-term capital gain with net investment income tax, and up to 13%. I'm sorry, 37% for ordinary short-term capital gain, then that's a pretty attractive deferral just on its surface, because the money you're not spending on taxes now is money you can invest, and hopefully by 2026 will have been grown to a much larger amount. So, and normally when you pay taxes late, you pay interest and penalties, but this is just a deferral. So even though you're paying it in 2026 instead of 2020, then you don't have to pay penalties and interest on it. So. I'm going to move on if there's no questions.
Nothing in chat, though there was a
Okay.
suggestion that we might go back and cover more on Roth conversions at the end.
Sure, I'm happy to go into it. I don't think I have a slide on that, but we can always put. I have a feeling we're going to have some time at the end, and I'm happy to go into those questions. So, one of the large issues that face investors when they do their taxes, and I'm sure most of you have run into this at some point, is the passive loss limitation rule. Right? Pre-1986, when it was the Wild West in the tax code, right? It was not uncommon for wealthy individuals that had high income from their jobs to go out and invest in, say, a real estate project that passed through significant losses after depreciation, right? And they would use those in amounts to offset the income from their jobs. This was extremely common and probably widely abused before they changed the law. So the IRS or Congress in 1986, when they did that tax reform under Reagan, said no more, right? So they put in these very harsh restrictions on deducting a loss from a passive stream of income. And one of the things that they did was they said all real estate investments are passive regardless of whether you're running them or not, right? So they don't distinguish between an investor-owned property versus an investor-managed property, if that makes sense. And so they very harshly limited the ability to deduct losses from these activities, including rental real estate, against income from other sources. So if your income is over $150,000 for a married couple, you don't get to deduct any of these losses, right? You can always deduct passive losses against other sources of passive income. But where this really comes into play a lot in my practice is that, for my investing clients, is if they have multiple, investment partnerships, and some of them will have large passive losses pass through, and others will have capital gain and interest, sometimes very significant amounts of it, and then they can't offset the loss from the gain, even if it's from the same partnership. So it's a bear, right? They made it hard to get around on purpose because they felt people were abusing this, and so you need to be smart about this and know what you're getting into, and try and find ways around it, right, as much as possible, or to generate passive income to offset against these losses, right? So passive loss can be offset at any amount of passive gain or passive income, right? But you're not allowed to deduct a net loss in general. So if your income's less than $150,000, then you can deduct up to $25,000 of passive loss per year if you have qualifying activities, right? So any loss that you don't get to use gets suspended and carried forward. It is tracked on a per investment basis. So if you sell that investment, then you would typically release any suspended losses that were associated with it. Or in the future, if you have passive income, it can be used, the carried forward losses can be used to offset it in the current year. Or if your income falls below $150,000, then you would be able to deduct up to $25,000. So there's a couple different ways you can, you don't losing the benefit from it, but you are deferring the current benefit of that loss into a future year. So, if you have a passive loss carrying forward when you die, it goes away, unfortunately. But the flip side is that, of course, your property that generated the loss gets a step up in basis to the current value, so it's not really something most people complain about. So I did want to mention that. So I mentioned a minute ago, like, you know, you can't use passive losses to offset investment income, capital gains losses, capital gains and interest and dividends and royalties from that are passed through from from other sources, even if the passive loss is coming from the same source. So since those items are separately reported and treated, excuse me, sorry, they're not able to be offset. So, you know, you can commonly see an investment fund that passes through a $100,000 passive loss that they can't use, and then $50,000 long-term capital gain that they can't use to offset, you know, with the passive loss. So it can create some frustration with some of my clients. So I mentioned before, the suspended losses, you can fully deduct the loss in the year you sell it. So, you know, if you have a portfolio of rental properties, for instance, then the suspended loss for each of those properties is going to be separately tracked on the tax return. And therefore, it's easy to identify when you sell that property, which loss gets freed up, right? So, of course, if you're doing a 1031 exchange and you sell that real estate, then the passive loss carries forward and does not get released. So, because you're not recognizing the capital gain, therefore you don't get to have the loss. But these losses are ordinary income losses. So oftentimes you're going to have a capital gain from the sale of a property that's taxed as long-term capital gain at a maximum rate of 23.8%, as we talked about, right? And then but the passive loss that's opened up, you know, and allowed you to deduct is deducted as ordinary loss, which is up to 37%, you know, capital or federal tax benefit. So there is some arbitrage there at times. So that's something you can take in consideration when you're planning. Because the reality is that a lot of times these passive losses are being largely generated by depreciation, which is not a cash expense, right? You know, when you report your rental income on a tax return, you're taking your gross income and subtracting out your operating and ownership expenses, right? And then you're also deducting depreciation, which is a portion of your cost of the property, right? So, so a lot of these times, a lot of these passive losses, you know, even if your property is cash flow positive, you know, in the reality, on the tax return it can show a loss, right? And it can be suspended. And so and depreciation also reduces the basis of your rental property, meaning that when you sell it, you have more gain, right? So this is why you're allowed to deduct that loss when you sell the property, is to say, okay, well, I'm recognizing this capital gain, much of which is probably being caused by this depreciation, right? So I'm allowed to deduct this depreciation expense on the other side to help offset those effects, right? So anyways, so I mentioned a smart and proactive tax strategy will look for ways to find passive income operating or opportunities for tax-free cash flow to be offset against these passive losses, or find other ways to effectively utilize these losses. That can be extremely complicated. So, and there's a lot of different things that can be done. So it's not really something I can just tell you a generic strategy, unfortunately, but that is something to think about potentially if you're running into this problem. So I mentioned before this real estate professional designation, right? First of all, it allows you to deduct otherwise passive losses, which would otherwise be limited, like we were just talking about, from rental real estate activities, right? But it's heavily audited, and that's why it's in capitalization. It is heavily audited because very few people that claim this, especially on self-prepared returns, actually qualify for it, right? So if you're going to adopt this position for your tax return, make sure that you are very familiar with the rules and have your documentation in a row, because you can see from the IRS's perspective that A, they're always going to try and say that they're only trying to make sure you're paying the correct amount of tax. And if someone's claiming the status that doesn't actually qualify for it, then they're not paying the correct amount of tax, right? But if you have someone claiming the status and that allows them to deduct $30 or $40 or $50,000 of passive losses, offsetting that much other income, then if the IRS swoops in and says, no, you don't qualify for this, they now have to pay tax and penalties and interest on $40 or $50,000 that's no longer deducted, right? So it's something that is a fairly lucrative undertaking for the IRS. So, and you know, any good IRS auditor will tell you, like I just said, that their job is to make sure you pay the correct amount of tax, not to necessarily assess more tax. But they have limited resources and tend to try and focus their attention on returns where they think an adjustment is likely, right? So, so they're not necessarily out on a crusade to assess more tax, but they're more likely to target returns where they think there will be more tax. So, if that makes sense. So, and so if this is one of the issues that they're auditing, it's one that frequently will result in an adjustment in the IRS's favor. So, just be careful. And but I mentioned before, as of 1986, when the Congress did the Tax Reform Act in 1986, they said all rental real estate income is passive, regardless of the circumstances, regardless of whether it's professionally managed by someone else or whether you're owner managed, right, or investor managed, and is therefore subject to passive loss limitations. So for most investors, this is the passive loss limitation that they're most likely to run into, right? So, but for real estate professionals, this limitation does not apply, which we talked about briefly in also for the net investment income tax portion, where we said that, hey, if you're a real estate professional, then rental income is not investment income for that purpose. Similarly, here it's not passive income for passive loss limitation calculation. So, and again, heavily audited. They like to audit these, and they usually win. So because it is a fairly narrow definition, and more importantly, is the next slide. Documentation, right? So if a real estate professional is a taxpayer who spends at least 50% or more than 50% of all of the time they spend providing services or working, materially participating in real estate trades or businesses, that is a bunch of legalese, right, to most people. But material participating means that they're spending a significant amount of time participating in real estate trades, right? A real estate trade or business is a little open to interpretation, right? But you're going to look at, brokers, developers, property managers, and in some cases, if you're doing it on a large enough scale, rental property managers, if you're self-managing properties, right? So a lot of times it's going to be pretty obvious, right? That it's a real estate professional. But one of the things that we get a lot of questions about is agents, right? And whether real estate agents qualify kind of depends on who you ask. And I'll usually, and the nature of what they're doing. So, but most of the time I will count those hours, right? But the second bullet point is the key when you get audited, is that you have to be able to document, prove at least 750 hours of the year, as well as the 50% threshold requirement, is that you have to be able to document the time that you spent doing this trade. And guess what? Nobody does that. I mean, especially self-prepared returns, they're not going to know they have to. And even if they do, it's a real pain to do. It's kind of like trying to keep a current and in the moment mileage log, right? For people who drive for work a lot. And for a lot of people, that's just really hard to remember to do. And so, and it can be hard to prove after the fact. And so the double-edged, or the two factors that you have to meet is the 50% of your working hours, right? And that you have to be able to document at least 750 hours of working in real estate trades or businesses. So, but if you have someone who is working a full-time job and then also investing in real estate on the side, then they're not going to qualify because they don't spend more than 50% of their working time materially participating, even if they spend 750 hours or more documented and proved participation in these real estate trades. So So between those two, the reality is that a lot of self-prepared returns, they'll just push the button that lets them deduct their loss, right? And they don't really, oh yeah, I meet this requirement, right? And then they get nailed in audit. So you have to be careful. It can be an expensive audit when it happens. So I had a question in one of my my tax professional groups as to whether a real estate appraiser qualified as a real estate professional. And there was kind of a mixed opinion. I think that it does, but it's not explicitly listed in the regulations, and so some people said that it doesn't. So I guess you have to decide if that applies to you, how you want to treat it. So, but everything is highly dependent on facts and circumstances for each taxpayer when making this determination and to whether they qualify for this treatment or not. So, and it is something, again, that I can't stress enough, they look at all the time, and they usually win. The IRS usually wins on those audits because it's very tough to thread the needle with all of these requirements. So, do we have any questions? I don't see any in chat. Does anyone want to add any questions? Nope. Okay. This is the weird side of doing this over Zoom instead of in person, is that I get no feedback from the crowd. So I hope that everybody is able to follow on with what I'm talking about. This particular issue is a little bit technical, and so I apologize if this didn't apply to you or if you didn't really follow what I was saying. Please feel free to reach out with questions either during the presentation or after if you have a question about any of this. This part is hard to. This is a topic that's hard to discuss without getting really technical and getting really into like language that makes sense to me as a tax person, but may not make sense to most people that aren't. So, so I hope I was able to break that down enough. So, cost segregation studies are quite powerful. I saved one client $1.3 million in taxes over 3 years due to this strategy, right? It all depends on how they're deployed and what your portfolio looks like. That guy had like a $60 million portfolio, okay? So he was paying a lot of taxes. In order to save a lot of taxes, you have to first pay a lot of taxes or owe a lot of taxes if you don't save them, right? So we mentioned before when we were talking about the qualified improvement property provision of the CARES Act that real property has a long recapture or depreciation life. 27.5 years residential or 39.5 years for commercial property. And if you go out and buy a new property, it's basically going to be all either land, which is not depreciable, or 39.5 or 27.5 years, right? There's not really a way when you first buy a property to break out parts of it that might not have such a long depreciable life, right? The cost segregation study is how you go about that, right? So typically they're looking for property that has a basis of at least $700,000 or $800,000 and is preferably commercial, right? A single-family residence is a hard sell for these, right? First of all, they cost a lot of money and it's hard to get enough out of it, and it's also less for single-family residences. It's less tested in court. Than it's for, like, if it's an apartment complex or a fourplex or that's has a lot of different units, then that's a little bit easier to sell, and it's a little more practical for it, right? So so that's why it's SFR, and I said not SFR is usually a single family residence. So they often have numerous components in them that qualify for shorter depreciation periods, such as 5, 7, or 10 years, right? And which may qualify for bonus depreciation, right? Even on top of that. So the client I mentioned that I saved a ton of money for had owned these properties for, I don't know, some of them since the 70s and 80s. And it's a bunch of commercial property in downtown Palo Alto. So you can tell that they've appreciated significantly. His wife passed away, a couple of years before I met him. And then he got the step up in basis. And all of a sudden this becomes something that's interesting to him, right? Because before, the properties were mostly depreciated and had a low basis anyways because he bought them in 1970 or 1980, right? And now they're worth millions and millions and millions of dollars. So we were able to use the cost segregation study. We hired a firm. He hired a firm that does these, an engineering firm. They send a team out to the property. They look at the blueprints. They look at the invoices of all the work he's done over the years, improving it, and was able to identify, well, okay, this system of this part of your property is not part of the physical building, right? You can say, okay, these are fixtures, right? Fixtures are 7 years instead of 39 and a half, right? This is an appliance that's 10 or 15 years or 7 years instead of 39 and a half, right? And so by going through and identifying those for, I think he did 6 properties, right? He was able to then break that out. And the second part of that is you're able to then adjust the depreciation accordingly to those and correct for any depreciation that should have been taken in the past. So we got this huge depreciation deduction in the first year that then carried forward, wiped out all of his passive income for the year, and then carried forward to the next year, wiped all the income for that year, and then was finally absorbed in the third year. And so that's how we saved him $1.3 million over 3 years. So, so you're not going to usually be quite that dramatic, right? But that just kind of gives you the idea of the potential of thinking in this way, right? And looking forward, how do we save taxes instead of looking behind? How should we have saved taxes? So, or what we call proactive versus reactive tax planning. So, however, so that's kind of all of this slide, right? That is what I talked about. Is we're segregating the cost, which is what it's called a cost segregation. It's not a very imaginative title, right? We're segregating parts of the cost to parts of the building that can be depreciated more quickly, and then taking catch-up depreciation claim, right, using Form 3115. So these are not inexpensive. They can typically run, it depends on the size of the building. I believe my client paid around $6,000 per building when he did his, plus travel costs because someone does have to come on site and examine the property, right? So, but it was a good investment for him. So, oh, sorry, are there any questions? I thought I saw one pop up in the chat.
It's from me. It's a property tax question you can cover later.
Okay. I'm unfortunately probably not going to know the answer to that, but I'll take a look. So
I thought I'd try.
yeah, it doesn't hurt, and I can always look into it and get back to you later. So, all right. So it's not all free money, right? Because you're not actually creating new deductions. You're accelerating the deduction of things that you've already spent money on, right? So it's a very important distinction to draw because you're accelerating depreciation, meaning that there's more recapture later if you sell, right? And after Tax Cuts and Jobs Act made the changes to the 1031 exchange rules, it can create a partially taxable transaction even if you do a 1031 afterwards, because all of a sudden now you said you've segregated out costs as not real property, and it's now personal property, which is anything that's not real property, right? And so now you may have to recognize gain when you do a 1031 exchange because of that, right? So, and I mentioned the cost is not cheap. So, in the case of my client, it was a real sweet deal because he's pretty old. The buildings are all paid for, and he's generating a ton of cash flow from them, and he's not planning on selling them, right? So, even though we were accelerating a bunch of deductions for him, when he dies, it's all going to get reset anyways, right? So, in that case, it made all the sense in the world to save those taxes and do the cost segregation. And his family was more than happy about it too. So you have to look at the long term as well. If you're not going to be holding the property for that long, it may not be worth doing these because of the cost and because of the recapture. But in the right circumstances, it can be an extremely powerful tax planning tool in order to take taxable rental income and reduce the taxable amount. So. Do you have any questions?
There was a question about inherited real estate. When one inherits real estate and receives a stepped-up basis, is an appraisal all that is needed to document the new valuation?
Yes.
If you
Data
sell
depth
it,
appraisal.
yeah, if you sell it within 6 months, you don't need an
I was about to say
appraisal.
that. Yeah, if you sell within 6 months, you can make the argument that the fair market value of date of death is presumed to be the same as the sale price because it was less than 6 months after the date of death. So, and sometimes that's an easier way to do it. But a real estate appraisal costs $500, and usually dealing with, at least around here, several $100,000 property, and so it's not a significant cost for most of the states to absorb. So in some cases, some clients will prefer to substitute a comparative market analysis or broker price opinion letter from a real estate broker. It's actually, I've never had a question, so I don't know whether it would hold up or not. So my recommendation is always to get the appraisal. So because then you have a licensed appraiser doing a qualified appraisal of the property, showing what the value is on the date of death.
So I was in probate recently, and they required the probate administrator ended up requiring, the court ended up requiring the appraisal to close probate.
I can see that. That's a separate issue, though, from stepped up basis, right? So, and, you know, we could be really pedantic and get into, like everyone calls it a stepped up basis, and it almost always is, but not necessarily. What it actually is a basis adjustment to the value at the date of death. And sometimes it's a step down. Not often, especially with real estate, but it can happen. So, but you know what? Even I call it stepped up basis because that's just what everybody calls it, you know, and it's very easy and convenient. And like 95 or 97% of the time, that's the case, right? So most of the time it is a step up. So, but when you do, if you inherit the property, you know, like I kind of alluded to when I was talking about the client that did this study, or the 6 of these studies, all effective depreciation are erased because you just get a fresh start on the basis. So, so that's why it was really powerful in his case specifically. So, because he's never going to sell these properties before he dies, and therefore it's well, in his case, it's kind of free money. So, we're talking about bundling deductions to maximize tax savings. It's something that's unlikely to have a really huge impact on your bottom line, but it can be something. We mentioned that this itemized deductions are now to $24,000 for a married couple that's over 65. They're up to $26,000, or you get a little extra. And so you're going to, as your mortgage interest amount goes down, and perhaps even your property tax stays low, hopefully, and your state tax goes down because you're earning less, it can become more and more common that you don't necessarily itemize, which was part of the design when they did the Tax Cuts and Jobs Act. So at least until 2026, and then everything resets unless it gets extended. So, and so in some cases you can, squeeze some benefit out of donation or property tax payment by doing them in multiple years in 1 year, right? It's like you say, okay, my property tax bill's due in November and April, right? And I can just, maybe instead of paying in April, I paid in December, and therefore I get to deduct it in this year. And by doing so, it may push me over the itemization threshold. Whereas if I didn't push it into this year, you wouldn't deduct it on either year, right? So it can create some small tax benefit where one might otherwise not exist. Right, and the same for donations, right? If you are a regular donator to a certain charity, you could consider like, okay, well, I'm just going to give you all of next year's donation in December of this year in order to deduct it on my return this year, because otherwise I wouldn't itemize and get any benefit from it at all. So it's something that can exist for some people, in some circumstances, but it's kind of something to be aware of. So. And that's why I call it bundling, because you're kind of like you're taking 2020 and 2021, for example, you're bundling it into 2020 or 2021. So, and you could do that the opposite way too, and give in January instead of December, if you wanted to move the deduction forward instead of back. So. This is something that can be very powerful. I'm hoping that most of you already knew about this, but if you donate property instead of money, you don't have to recognize the capital gain or loss you would normally have to if you sold that property. So if you have a highly appreciated asset, it's like if you sold it for $1,000 and had to pay $300 of tax, then you'd only have $700 to donate, right? Whereas if you just donated $1,000 worth of stock, you get a $1,000 deduction, right? And you don't have to pay tax on that $300 of tax. So it's kind of a double benefit. And most decently sized charitable organizations are more than happy to take stock from you. So that's not a donor advised fund is a question about it. It's on the next slide, so it's fine. So so if you're donating assets other than publicly traded securities and the value is higher than $5,000, you will need an appraisal on the donated item. But usually when that's going on, the charity is more than happy to help you facilitate that. So if it's a publicly traded security, then you know the fair market value based on the stock price, right? The closing price on the day of the sale, or sometimes they do a high-low average method. But usually the charity will provide that document that shows, hey, we received this many shares worth this much, right? The other item is like a car. You know, there's been a lot of, I'm sure many of you donated a car to a charity in the past several years. They changed a while ago because there was like a total free-for-all out there for a couple of years where everyone was claiming these wild valuations of their car donated in order to get a huge deduction. So, oh no, this car is worth $5,000, right? And they would deduct the full $5,000. So the IRS came out and said, okay, no, you can only deduct what the charity actually sells it for, because that's the fair market value, which is kind of hard to argue if you think about it. So, argue against rather. So, so now the most you're allowed to deduct without documentation from the charity saying how much they sold it for is $500 for a car specifically, right? And if you donate a car and they sold it, then they will give you a 1098C. I think it's a 98C that shows the details of the sale, the date it was sold, how much they received, is everything, and that's how much you can deduct. So, right. So again, though, if you have investments or real estate that you're planning to leave to charity, then you can consider, or to donate to charity, you can just donate it straight across and not have to worry and not pay any tax on the appreciation of the investment. So it can be an extremely powerful thing. I have clients that donate their Apple RSUs that they've been holding for a long time. Or again, I keep saying Tesla because it's appreciated so much this year that I'm sure some of you own it, that, you know, it's been such a huge rapid increase in value that may be something that you own, that if you sold it, you would have to pay a high amount of tax on. And if you are planning to make donations anyways, then this can be a way to make it much more tax efficient. So, question on the chat was about donor advised funds. So it's good that someone asked about that, but I was already going to cover it anyways. So, so donor advised fund is usually held by a brokerage like a Fidelity or a Schwab or something like that. And Fidelity has one that's very prolific. I frequently see clients using it. I'm sure others exist as well. But it's basically a charitable fund that you can donate cash or property or stock to, and take a deduction for the fair market value, and then control where that money goes to different charities over however many years afterwards. So it's a kind of a form of bundling like we talked about before, but it can be for more than just 2 years, right? So if you give $500 a month to a certain charity, and then you sell a bunch of property or sell your house and have a $300,000 capital gain that you have to pay taxes on, then you could say, okay, well, I'm going to donate $48,000 to this donor advised fund in that year, and then give $1,000 per month to my charity over the next 4 years, right? But then you get to deduct the $48,000 in year one, even though the charity may be getting, well, I said $500, and then I made the calculation for $1,000. Sorry, but you know what I'm saying. So you can deduct the full amount you contribute in the first year, even if the money is actually being distributed to charities over time in other years. So it's a way to capture a charitable deduction in the year where it's most beneficial, assuming you have the cash to do it, and then still not create unreasonable expectations from your charities of how much you're going to be giving them in the future. So. Because I don't know about you guys, but you know, you give the charity a bunch of money and they're going to expect it again. So most of the time, so that's my experience, anyway. So, and again, most, if not all, donor advised funds can accept stock. So if you're trying to deal with an organization that isn't set up to handle receiving stock donations, this can be a way that you can donate the stock to the donor advised fund, get that tax benefit of the full fair market value deduction for the shares without having to pay tax on depreciation, and then just give cash to the charity. So we can help simplify their administration for the ones that are a little bit smaller and less institutionalized. So, So, and again, like I mentioned, hey, you take a big chunk, a big deduction in the year where you have a lot of income, and then you can still dole out to your preferred charities over time. So this donor advised funds were not included in the waiver of the 60% of AGI limit for under the CARES Act. I mentioned that on that slide, but since we're talking about donor advised funds, now I want to say it again that if you're writing a check to a charity like Second Harvest or whoever, right, then that is not subject to the 60% limitation for the year. But a donation to a donor advised fund still would be, whether it's cash or stock. So
a nice thing about the Fidelity, at least for their donor advised fund, is they issued a statement that specified the cost, your value at the time, so you had a written statement from them for taxes.
yes, the form is, I think, 8283, the tax form for it, and the Fidelity and most, I think, other funds provide a filled out copy that shows, how many shares of what you donated and what the value was. Most of the time when you donate property or charity, they're not allowed to give you a valuation, and that's why you see that on all the Goodwill and stuff receipts that when you get them. But for this, they can, and they'll tell you the method they use to determine the value as well as the value. So they are very good about that. Makes my job easy. So qualified charitable distributions have been around for a while, the QCDs. So many of you should be familiar with them, hopefully. They kind of were like temporary for a long time, and then they kept expiring, and then they would renew them, and then they'd expire, and then they finally made it permanent. So permanent until they change it again anyways. But it doesn't automatically sunset after a period of time. But it's a way to take money directly from your investment or your retirement accounts, IRAs, and donate them directly to charity and not pay income tax on that distribution like you normally would, while meeting, it will count towards your required minimum distribution requirement in years where there is one, which is every year except for 2020, right? So if you're required to take out $20,000 from your IRA, then you would normally take $5,000 and donate it to a charity. Then you can just take out 15 and have 5 cents to your charity, right? And if you don't itemize deductions and wouldn't get a deduction for that donation, then this can be a way to avoid having to pay tax on it anyways, right? So again, we talked about before when we were talking about bundling deductions into between years, is that there's a lot of clients, especially retired clients these days, that no longer itemize deductions because the standard deduction is now so high. And so if they do have an RMD, I've been encouraging them for a while to do this instead. Is that, if you take the money that you would normally donate, and instead of donating it out of your checking account, donate it out of your IRA. And then that way you don't have to pay tax on it, and they still get their money, right? And you still get your RMD requirement satisfied. So the tricky thing about this is that there's no indication on the 1099-R of this. So if you do these, make sure you tell your tax person about it, because we'd be more than happy to take it out of your taxable distribution. But the broker, the institution that sends the 1099, doesn't make any indication on the 1099 of it's just an ordinary distribution to them. So so you have to make sure to track that separately and make sure you don't double dip, and also make sure that you get full credit. I mean, by double dip, I mean not pay tax on the distribution and then also deduct the deduction on your Schedule A if you itemize, right? And you also need to make sure that you're not paying tax on that part of the distribution if it did go to a qualified charity. So, but this is again a way to this is a tax-free way to get money out of an IRA, and you can do up to $100,000 per year. So that's obviously kind of an extreme case, but I do have clients that are doing that because IRAs aren't the best asset to pass on to your kids necessarily, because they have to pay tax on it when it comes out, right? So some of my clients in their estate planning have decided, okay, well, my kids are getting other money, and therefore I want to leave this money to charity instead, and they're using these QCDs as a way to do that and drain their IRAs without paying tax on it. So because if you took out $50,000 from your IRA, right, and then that money hit and then donated it, is that you would have up to that amount of money on your income, right? And then and that can have other consequences like we talked about before with the passive loss rules, where all of a sudden maybe that pushes you over that $150,000 threshold, and you can no longer deduct your passive loss, right? Or maybe you have medical expenses and you can only deduct the amount that's over 7.5% of your adjusted gross income. So even though you'd think, oh, I'm putting in 50,000, I'm taking out 50,000, they can have other consequences, right? So, and you know, a smaller hit could be, you know, maybe you weren't going to itemize, but because of this $50,000 deduction, if it's an extreme case, I allow, right? But you do now, and therefore you're losing some of the benefits that you would have gotten anyways from the standard deduction. So, in a case that didn't make sense, you know, I had a client in my office this year who had some gambling income. They go to the casinos, right? And they made no money, but they had to report about $40,000 of winnings, right? And $40,000 of losses. Now, for those of you that aren't familiar, you deduct itemized gambling loss up to the extent of winnings as an itemized deduction. But without that, he would not have actually had to itemize, and so he did lose some benefit. I think I calculated that it cost him around $5,000 or $6,000 of additional tax that he would not have paid if he didn't have these gambling winnings and losses. When I told him that, he went, oh. So, you know, it's something that a lot of people don't kind of think about, and so and it's not going to always be that dramatic of a difference. But there are some benefits to not having the income appear on your tax return at all versus having it appear and then deducting an equal amount as a donation. So that's the point I'm trying to make, is that a lot of times it may not matter, but sometimes it does, you know. And when it does, it's nice to not have to do it. So.
Are you?
Go ahead with questions.
Yeah, is the amount of QCD limited to the RMD, or is it limited?
No.
It's limited to the
$100,000
unconditionally.
Yeah.
For the QCD to apply to the RMD, it needs to be taken before other distributions, or
No.
does it matter?
No. The RMD is not, it's not, the timing of the RMD doesn't matter. It doesn't matter whether you take it on January 1st or December 31st, right? Required minimum distribution is calculated based on the life expectancy tables using the value of the account on December 31st of the prior year. So for 2020, if there was an RMD, it would be based on the value of your retirement account on December 31st, 2019, right? And as long as you take out at least that much, the requirement is met. And whatever, if you take out more, it doesn't matter. If you do part of it as a QCD, that doesn't matter either. So
And the timing doesn't matter. So if
timing does not matter.
So if you took out 20,000 as a distribution and then 100,000 as QCD, you're okay.
Yes, I believe that would be the case.
Okay. Thank you.
You know, I have a client that is retired and living off her investment income, and she had, when she sold her business a number of years ago, she arranged for an annuity to be paid to her son for his entire life, right? And as part of his inheritance. And so she's like, well, he has this, he doesn't need my IRA, and so she's given $100,000 a year to charity until it goes away. So, and she's not paying any tax on that, and then the assets that are left to the son, he won't have to pay tax and take the money out either. So extreme. But it's something that people can use, you know, and it doesn't have to be 100,000. It could be 5,000. It could be 500. I have clients that give, you know, $700 or $800 a year in QCDs out of 14,000. It's just, the point is that it's money that they may not otherwise get a deduction for that they're not going to have to pay tax on. So, yeah, so any amount really is fine. I've spent a bunch of time on this particular topic, so because I think it's both interesting and important, especially as you go through your retirement, you know, and the amount and nature of your income and deductions change. That can be something that's important to keep in your back pocket, especially since it is permanent now. So, as permanent as anything is. So that's the end of my material. I'm about 20 or 30 minutes early, so I'm more than happy to open up the floor to any other topics that I didn't cover, or if there's questions about things that they'd like me to cover in more detail. At worst, I'll punt and tell you that I'll need to get back to you on it if it's something that I'm not exactly sure of the details on. So, but please feel free to. to bring up any questions. So, and if you don't mind, I can just monitor the chat now, and rather than having you read the questions to me,
Okay.
since I'm no longer presenting. So,
The one disappointing thing about the QCD is it can't go to a donor advised fund.
no, I don't believe it can. So, I'm not actually. I don't think that there's any restrictions on which type of charities, because like oftentimes when you're doing like an employer matching program, they'll say, oh, can't go to like a religious institution, right? Just that's their policy to avoid controversy, right? And I don't think that there's any. I have seen QCDs go to temples and synagogues and to churches, so that's not a restriction that you have to worry about as far as I know. And I don't believe that there's any restriction like that from the donor advised fund either, although that may depend on the actual fund.
They have to be, is it 501c or something? They have to have the right.
501c3. So 501c is the paragraph that talks about nonprofit companies, but not all nonprofits are charities, right? Because there are like 501c4s, which are things like, I believe your investor group would probably be one of them, or my professional business league for enrolled agents is one. It's a nonprofit that is commercial nature, where we don't have to pay tax on any net income, but you can't deduct any donations or contributions to it, right? Or it could be like a fraternal order, like the Moose Lodge, or something like our Elks Lodge. There's also 501c6, which are like political committees, right? So there's a lot of things like that. So, and some of you may remember a number of years ago there was a big supposed controversy about the IRS discriminating against conservative nonprofits because, but a lot of them were applying for the 501c4 status instead of 501c6, and there's a lot of rules that apply differently as to what they can use their money for and how they have to report it. And so at the core, regardless of whether anyone had an agenda or not, I think that was if I remember correctly, that was the issue. So there's a lot of different 501c organizations. 3 is the one that most people know about, because that's the one that's a charity you can donate to and deduct the donation for. So.
Okay, there's several questions in chat that have just come in.
Sure, good. Let me scroll up and do them in order. So, is there any way to avoid withholding on closing an IRA? And the state had a small IRA with no beneficiary specified. I was unable to convince the administration to not withhold federal taxes. Resulted in delaying close of the estate by a year. Even though the state has no income for 2020, a tax return will need to be filed to transfer the capital gain loss on the sale of the home. Keeping the estate open and distributing the IRA over time is not the preferred option. I don't know that there's actually an IRS rule that says that tax has to be withheld. I hear from clients often that they're told that there is a rule. I've always kind of assumed that it's an internal rule for the custodian. In the case of this one, I don't think that was improper. I think that because the IRS needs to know that they're going to get paid the tax that's due on that distribution. And if you leave it up to the beneficiaries to pay the tax on it, in this case, you said it was a small IRA, and I don't think they differentiate based on size, but there could be more trouble collecting it later. So typically the IRA, if it does have a beneficiary, can be rolled over or into an account under the beneficiary's ID and then reported under that tax ID number. But if it's going to the trust and the trust has to pay tax on it, or a state, then I think that was probably the proper thing to do, even though it's annoying and inconvenient. I'm sorry. So.
Okay.
And Pat has asked to discuss the qualify for the 20% deduction for qualified business income, or QBI, pass-through income. I own 2 SFR rental properties and could place them in an LLC. So I had actually addressed that before we started, because I saw that question, Pat. So I hope you saw or perhaps you didn't see my response then, but I'll repeat it now since it's part of the recording. So for those that aren't familiar, QBI, or qualified business income, is a deduction for federal purposes, a reduction of federal taxable income that was passed as part of the CARES Act. I'm sorry, the Tax Cuts and Jobs Act. I'm getting all mixed up now. Tax Cuts and Jobs Act, and it's a reduction of taxable business income meant to create some semblance of parity between the fact that the corporations are now paying a flat tax rate of 21% instead of 35%, right? So the question she asked though is, does a single family rental property qualify for this, right? And the answer is yes, probably, right? So there's a lot of arguments that went around the tax preparer community in 2018 about this, but the general feeling is that, when it comes to tax court cases for unrelated issues to QBI, whether rental property is considered a trade or business in general, the bar is pretty low. And generally, if you're operating the rental property with a for-profit motive, meaning that you're charging fair market rent and making reasonable attempts to maintain the property and make sure it's occupied and rented out, right? It should qualify, right, as a business property or qualified trade or business, and therefore would qualify for the QBI. So even one property, even if it's a single family residence, can qualify, right? This only applies though if you have taxable income from the property. If you have a loss, then this doesn't help you. So, and then the mention of the LLC, that's irrelevant. So an LLC will just pass the income straight through to you. If there's only a single owner, it'll still be on your personal tax return on Schedule E. If there's two or more owners, then you'll file 1065. It'll issue a K-1, and the K-1 will pass that income through. And the nature of the income and whether it qualifies for QBI will not change, regardless of how it's treated or how it's owned. So, oh, you actually quoted my answer, so I'm not sure if there was a follow-up question for that, Pat. Please put it in the chat, and I'll as I go through these questions, I'll get to it. Okay. So. Are backdoor Roth IRA conversions still allowed? Yes. Explain the mechanics of how to do it. I'm not really sure what the question is there. I'm going to try and answer that, Bob. And if I don't answer your question, please clarify in the chat, and I'll get to it. So, and I'll explain further. So, a backdoor Roth conversion is because you're only allowed to contribute directly to a Roth IRA if your income's under a certain threshold, but you're allowed to contribute to a traditional IRA, no matter what, up to $6,000 per year if you're under the age of 50, or $6,500 if you're over the age of 50. No, $7,000. Sorry, $7,000 if you're over the age of 50. So, although you may not be able to deduct the contribution to your IRA if you're covered by an employer-sponsored plan. So a backdoor Roth is called that because there's no income limitation on converting a pre-tax account to a regular IRA to a Roth IRA, right? There's only a income restriction on directly contributing to the Roth IRA. So you can make a non-deductible contribution to a traditional IRA and then convert it to a Roth IRA, right? So the mechanics of how that's taxed can be complex because when you put money into a traditional IRA, it's typically pre-tax money, right? That's how they're designed to be used, and therefore the money you put into the pre-tax account, it grows tax deferred, and when the money comes out, it's all taxed as ordinary income, and you just deferred the tax on the growth of the account and the income that the account received over the time, allowing you to compound the growth more quickly, right? So if you put non-deductible contributions into a traditional IRA, then it creates what we call basis in the IRA, which is money you can take out of the account later and not pay tax on. But of course, it cannot be as simple as putting money in and taking it out and having it non-taxable first in, first out, right? It is for Roth IRAs, but not for traditional IRAs. Traditional IRAs, you recover the basis over withdrawing the entire amount in all of your IRAs. So what I tell people is, like, if you have a $90,000 IRA and you put $10,000 without deducting it, right? Then you have a $100,000 IRA with a $10,000 basis, right? And if you then take out $10,000, you've taken out 10% of that account, and therefore you get to recapture 10% of your basis. So if you put in $10,000 and then converted it, you would, in that scenario, you'd have a $9,000 taxable conversion because only $1,000 or 10% of the basis would be recapturable or recoverable in that transaction. So I think that's what Bob is asking, but if that doesn't clear it up, or if there's other questions, please let me know below. So can medical deduction be taken for family home care expenses from Renee? So yes, probably, right? So when oftentimes when people are asking this question, they're talking about a family member that can't care for themselves and needs in-home health care. And if you're paying for that, then it's deductible as long as they're unable to independently function without help in 2 of 5 areas. And unfortunately, I can never remember which those are, but I think it's dressing, bathing, toileting, and I think there's 2 others, but unfortunately I can't remember. But if they can't do 2 out of 5, at least 2 out of 5 of those things independently, then 100% of that cost counts as a medical expense. So for tax purposes, anyways. So, and again, I believe that's answering your question, but if not, please let me know. So.
Just details, Roth conversion or calendar year, and there's no redo any longer, correct?
Correct. Yeah, up until tax cuts, I think Tax Cuts and Jobs Act, you're no longer allowed. You used to be able to unwind a conversion after the fact, up until the due date of a tax return. If, for instance, you decided something happened, you couldn't afford the taxes after all, or if the account value was unfavorable, right? You no longer can do that. Once you've done that conversion, it's permanent. So. Please explain more about how Roth IRA conversion works. Is there any limits on converting rollover IRA to Roth IRA? From Carl. No, there's no limit on how much you can convert, but whatever you convert, you have to pay tax on. Although we did discuss earlier that there's a coronavirus-related distribution, if you qualify, can be up to $100,000 and paid and taxed over 3 years. And there's no restriction saying you can't convert any amount of that. So. And Radford says, I have several friends and family members looking to move out of California to Nevada or other states without a state tax. Do you have any advice on doing this move correctly? The way to do it correctly is to actually move and not pretend to move. So first of all, unless you're high income and high net worth, California probably will not care that you're moving out of town, right? But if you do have significant tax at stake, what's at stake is whether you're a California resident or not. And the reason for that is because if you're a California resident, 100% of your worldwide income, regardless of its source, is taxable to California, right? Whereas if you're not a resident of California, only California sourced income is subject to California tax. So I'm sure you can see the motivation there for the state of California to make sure that people are actually moving, right? And so it's, and everything is facts and circumstances. It's fine to maintain a home in California. You don't have to completely sell your property, right? But they look at things like, you have to not spend more than 183 days per year in California. So you have to track that, right? If you're going to spend significant time here, because that automatically makes you a California resident, right? And so, but, where are you banking? Where is your place of worship? Where is your job? If you have it, where is your family? Where are you vacationing, right? What is the tax return, address on your tax return, right, when you file? These are all not definitive, or where are your bills being sent, right? What is the address on your utility bills and bank statements, So these are all not definitive, surefire criteria. These are things that they look at, right? And they would be able to kind of build a picture as to whether or not you've actually moved or not. And it is perfectly permissible and legitimate to move and split your time between California and different states. The question is just how much of your income is going to be subject to California tax. And so you want to just make sure that you're actually moving and making it look like you're actually moving, even though sometimes that's a little bit less convenient. Where's your driver's license, right? From what state is your car registered? Where are you registered to vote? All of these things, right? So I don't know that there's a definitive list of everything they look at, but it's kind of like a case they build across a number of different factors, right? But the most important thing is to not spend more than half of the year in California. So I have some clients that are in the younger side that have RSUs that have not vested, right? Restricted stock unit or stock options. Stock options are pretty rare these days, but RSUs are fairly common, and they'll say, okay, or they have appreciated stock, and they say, okay, if I move and then sell, do I owe California tax, right? And if you sell an investment after you move out, then the capital gain should not be subject to California tax unless it's California real estate, right? And then for like restricted stock and stuff like that, what they actually do is that if it was granted to you while you were a California resident, it's still taxable in California when it vests. When you sell it, it's not a California transaction, right? So it's kind of annoying for some of my clients because they move and then they still have the California income for a couple of years and they don't expect it, so. Deborah asks, how much income can an irrevocable trust receive before needing to file a tax return? The answer is $300. It's a very low threshold. So $300 is the standard deduction amount for a trust that's not passing its income through to the beneficiary or the heirs. So it's a very low threshold. So if you have a small estate or trust that just leave it in a checking account, the cash in a checking account, and don't put it even in something that's going to pay interest just in case. Then you don't have to. Now, is that enforced? I don't know, but it's not. I don't know that the IRS would spend a lot of resources chasing that down. But technically, the answer is $300. So.
Thank you.
Deborah also asked, in-plan 401k Roth conversions roll over to IRA Roth. Anything to gotchas? No. The only confusing thing about that. Okay, so. For those that aren't familiar, certain employers, I see this a lot at Google for whatever reason, and sometimes at some of the other tech companies as well. They allow their employees to contribute non-deductible amounts to their company plan, and then do an in-plan conversion, which is so. If you have a 401k at work, then most of them by now should have the option to do either a pre-tax or a Roth post-tax contribution, and some of the ones that are nicer will allow you to do an in-plan conversion, which means they, in effect, make a distribution without actually making a distribution from the pre-tax to the post-tax side. And if you have basis in there from non-deductible contributions, then that would also carry over as well, and it would reduce the amount of the conversion that's taxable. The only confusing thing that happens there that kind of throws people, in my opinion, is that when you get the 1099-R from the company, so let's say it's Vanguard, because that's who does Google, right? That's the one I see most frequently. So there'll be a 1099 from Vanguard, and it'll show, it'll say $24,036 in box 1 of your gross distribution, and then in box 2 it'll say $36, that's the amount of taxable. But then it'll say code G, which means none of it's taxable. So what they're saying is that of the $24,000 or whatever the number is, then $36,000 is from income that the fund received, but it's still not taxable. So it's just a little bit of a quirk in the way that the reports come out. My tax software always throws a fit when I put in that G and there's still a number in the taxable amount. And the answer is that, because that would just be if we're not quite paying enough attention, because the answer is that it's not actually taxable, even though it's in box 2 and says it's taxable, right? So, and that's why things get a little confused.
So when I have a after-tax account that has earnings, and there was a partial rollover to a Roth. It should show the total and the taxable amount, correct?
But the taxable amount should be 0 if it's a rollover, but it may show in taxable
conversion.
Amount, it's not actually taxable, right?
Okay, so you're talking the rollover from the Roth, from the 401k to the IRA, but there would also be a 1099 for the in-plan conversion.
In-plan conversion, yes.
Okay, thank you.
So, so if you were to leave your employer and you had money in pre-tax and post-tax accounts, which should be the case because if nothing else, any employer match always goes into a pre-tax IRA 401k side of things, right? Then you should get 2 1099-Rs, one for the pre-tax portion of your rollover and one for the post-tax or the Roth portion of your rollover. So. And then Phil asked, isn't an IRA rollover tax at your California tax rate for the state tax? Yes. I'm not sure if there's more to that question because I feel like I might be missing something. So
rollovers aren't taxed, are they? It's conversions that are taxed.
Oh, rollover. I'm sorry. No, rollovers are not taxed. You're correct. I'm sorry. I was thinking distribution. So. Oh, and sometimes people have a question about whether their retirement or pensions would be still taxable by California after they move out if they worked in California. The answer is no. They tried. They lost. I think like a number of years ago, there was a lawsuit about someone who's drawing like a teacher pension from CalPERS or STRS, right? And they were saying, oh no, this is a California pension, from California, employment, so it's still taxable. And the court said no. If they're not a resident, you can't tax them on that. So. Okay, it's come to the end of the questions, and we're about towards the end of the scheduled time for me to speak. If there are other questions, I'm more than happy to keep answering them for a bit. But it looks like we might be done. So,
is there any way to roll over a 401k that has mixed pre-tax and after-tax and keep them separate for a Roth IRA, for a Roth rollover? It's probably required to do it before you roll it over.
So the employer plan is going to keep an accounting of what portion of your money in that plan is pre-tax versus post-tax. And as I mentioned before, there will be two distributions for rollovers, one from the pre-tax and one from the post-tax. And so that's how it's going to be, is because you're going to roll it over into two separate accounts. Because the pre-tax will be rolled over into a traditional IRA and the post-tax will be rolled over into a Roth IRA. Is that what you were asking?
Well, there's also another category for after-tax contributions to a 401k, non-Roth.
I believe that if they hadn't been converted, would go into the traditional IRA and create basis in that IRA.
Yeah, so that it needs to be converted before transferring to keep the basis separate.
Yes. And the reason that it can matter is that, like I mentioned, is that if you're doing a backdoor Roth and you have money in an IRA from an old job or from when you were working before you had a 401k, or then it can make the backdoor Roth cost money, because you're going to have a taxable or partially taxable conversion whenever you do that. So and Jean had reminded me that she's asked earlier, what are the options on inheriting a parent's home with Proposition 19 regarding the property tax basis? Unfortunately, I will have to punt on that one because I do not know the answer. I'm sorry. It is a new proposition, and it is a property tax, a real estate tax, or almost question rather than income tax. And so that's unfortunately out of my area of expertise. All right, I think that's all the questions then. I thank you all for sitting here for the last almost 3 hours listening to me natter on about taxes. I hope that you've gained something out of it. On the last slide, you'll see my contact information. If you have questions, you can always shoot me an email. If you'd like to talk about, tax planning or tax consultation, then you can always schedule a time for us to talk. I'm not in the office since March because of the pandemic, but I am doing meetings over Zoom and phone, which has been working well for most people. So,
would it be appropriate to remind people the limitations of non-trustee to trustee rollovers per 12 months, or
one? You get one per year.
One per 12 months, not calendar year, right?
Oh, okay, yes. So a non-trustee to trustee. So most of the time when people are doing an IRA rollover or a 401k rollover to an IRA, they're going to have one institution directly send the funds to the new institution. And that's when you're going to get the 1099-R that shows the code G for rollover, right? If the institution instead cuts a check to you and mails it to you, then the 1099 will not have code G on it. But you do have 90 days to up to 90 days to deposit that money into a qualifying account, and that is referred to as a not indirect rollover or non-trustee to trustee rollover. So funny thing about that is that the 90-day limit may not always be really strict. So the IRS a while ago created a way that a taxpayer can self-certify at almost any, I think until the due date of a return, that they believed the money had been, that they lost the check or they thought had been deposited into a qualifying account even if it wasn't, and then correct the issue and deposit the money into an account, I think up until the due date of a return. So I've never had to do that, but there is an option for, because sometimes people do, they get the check and they go to their bank and they deposit and they think that it's been rolled over when it hasn't been, right? It's just been put into a bank account. Or they get the check and they forget about it, or they lost it, or something like that, and then so the money never gets deposited or put into a new account. So, so it can happen. So, And then as Deborah said, there's one per 12 months, not one per calendar year. So.
Okay, I think we're about done. Russell, thank you very much for covering the taxes. It's a very important presentation, and particularly this year, much more complicated than usual. But appreciate your
Congress likes to keep us busy, so but it's good job security for us. So
yes. Good. So I think all the questions are answers. Deborah, you're finished. So thank you very much, and we will. I've got 2 pages of notes, so.
Well, if once you go over them and try and type them out and straighten them out and organize them, if you have any questions, please reach out. So
thank you very much. Have yourself a good day.
Take care, everybody,
and stay safe. And thanks for the whole chapter for what you
Sure.
give today.
It's been my pleasure. We're looking forward to doing it again next year if you need me to.
Okay.
All right, bye.
Bye.